we said that if inherent and control risk is high, that means detection risk is low, it's more work for the auditor. But where the inherent risk is low, detection risk is high and less work for the external auditor. So please take note of it and try to understand, memorize, and see how to apply it in graphical scenarios. Okay, so we're looking at, we just spoke to the audit model or the audit risk model in summary. Let's run through section 3, speaking to inherent risk practically. Inherent risk are those risks that an item may be misstated due to its nature or environment, regardless of whether there's controls or detection. Inherent risk cannot be controlled or eliminated by the auditor. So it's the nature of the environment or where the business is domiciled. That's what brings about the inherent risk. And the sources of inherent risk includes nature of items, for example, the estimates, the provisions an organization makes, fair value adjustments, fair value measurements, the nature of the entity and the industry. Volatile sectors like the construction business space, oil and gas are inherently risky. They are more prone than stable ones, talking about food manufacturing or the manufacturing of clothes and other sectors of manufacturing. So these are the sources of inherent risk. And the implication is that a higher inherent risk speaks to a higher chance of financial statements misstatement. And the auditor must actually accept inherent risks exist and plan his work accordingly with the fact that those inherent risks exist. So in assessment or in assessing inherent risks, the auditor uses knowledge from his prisoner's previous audits, understanding the current external and internal environment, and the two levels of inherent risk or understanding the environment of the business speaks to the financial statement level. At management level, the management, do they have integrity and the competence to prepare the financial statements based on the applicable framework? So at financial statement level, the auditor needs to measure that. And the nature of the business also, the industry, the economic conditions, factors of production affecting the business must be assessed. Then aside the financial statement level in assessing the inherent risk, we look at the account transaction level. That is the nitty-gritties, the transactions that culminate in production of the financial statements, the subjectivity measurement of those transactions, the complexities of the transactions, the asset characteristics. For example, cash is easy to misappropriate, but where you have an environment that is clearly bank and transfer, it's not easy to manipulate that. I worked in a pharmaceutical company where you don't do cash transaction. The control environment is very strong. They don't accept cash of any kind. I was the branch accountant then. I worked there for 3 years. And in that space, pharmaceutical space, for that 3 years, there was no day I saw cash physically. The only cash I handled was petty cash. And the threshold then was 200,000 immaterial. So you see, when an auditor sees such an environment, that the inherent risk is very low. But where you have, and the budget in that space, that business space, pharmaceutical industry, FMCG pharmaceuticals, I worked then. In that space, they do ₦1 billion sales then. That was 2018. I worked there between 2017 to 2020 for 3 years. ₦1 billion sales every day, and they don't do cash. So an auditor will naturally know that this is a strong control environment around revenue recognition, around cash controls. So the complexity of cash, of transactions, asset characteristic, talking about cash, and their easy way to manipulate or misappropriate. Looking at the control environment, that business must have, management must say that no, cash will not favor us. POS, in fact, they don't do POS, you only do transfer. You don't come with your POS to the office and you only do transfer or nothing. Those are strong controls that help accounts at their transaction level. So a practical example speaks to a CEO CEO as a major shareholder plans to sell his shares soon. The inherent risks of at the financial statement level is that there may be bias or incentive to window dress profit and position since he will be selling his shares soon. So the auditor needs to be careful and assess the inherent risk very carefully. So for exam tips, you must understand that inherent risks are built-in risks. They are follow-come. Let me use the word follow-come. It exists before any controls. So always separate financial statement level risks. Example, minimum bias versus account or transaction level risks, speaking to estimates and complexity. So in case study questions, look for estimates, complexities, incentives, or a volatile industry like the oil and gas business space to really anticipate such questions as they come in the AAAF paper. All right, so that's inherent risk. I think it's a bit more lucid and clear with this practical definition. Kachi and Grace, I think you grasp the concept of inherent risk better a bit here, right? Are they on the call?
Yes,
Okay. I hope Grace is still concentrating.
Yes, sir.
Yeah, so I think the concept of inherent risk is a bit better here as it's dealt with on the section. So let's look at control risk, the next risk, which is section 4. Is a risk that a misstatement will not be prevented or detected or corrected by the client's internal control. That means there's a deficiency in internal controls. That's what control risk is all about. And the key points around control is that the auditor must assess control risks from different audit areas. He must look at the transaction cycle from beginning to end. That's the end-to-end transaction cycle. And the assessment is based on test of controls. Look at the design of the controls. Do they operate effectively, or they are just policies people don't use? Something like that, or SOPs are there, but they don't follow it. So that's design and operating effectiveness. So the default assumption for auditors is that control risk is high unless evidence shows controls are effective. So for example, when I got to the pharmaceutical place where I was working, I will assume control risk is high, but immediately I saw there was no cash transaction. Everything is transfer. I mean, controls are effective because money goes straight to the bank account of the business. So I'll, from that evidence, show that controls are effective and control risk is low. So control can never be zero. Control risk can never be zero. Understand that. All control systems have inherent limitations. So for example, collusion, human error, management override are all control risks that are inherent in any system. And the implication for audit planning is that where we have a high control risk, auditors rely more on substantive testing. But we've said that over again, where we have low control risk, with evidence, auditors can reduce that substantive testing, but still require some, at least, level of testing. So management rule in addressing control is that for the current year, control risk cannot be reduced by auditors. If it's the first time audit, they can only assess. Then for future years, as they go ahead with, management may implement stronger controls based on recommendations and possibly based on the auditor's injection of his expertise. Control risk may reduce. So the exam tip is that you need to think of control risk around if controls fail, misstatements survive, and control risk exists. But if controls are strong, misstatements don't survive, and control risk are brought to the barest minimum. So watch for scenario clues where control risk around segregation of duties. A question may come around that. Poor authorization, no approvals. People just do things the way they like. We've seen some questions like that. Ineffective reconciliations. All these scenarios point to high control risks. Very, very important. Okay, so any question on control risk very briefly? Or any contribution?
Sorry, I need to come again. No,
yes, please. Don't be sorry. Go ahead, please. Go ahead.
Where inherent risk is high and control risk is high, it automatically means that detection risk will also be high. What shall the auditor do?
It's low. is low. That is why Kachis use the word is inverse. Where control risk is, inherent risk is high, control risk is high. That means you have detected it now, so your detection risk is low. It's where inherent risk and control risk is low.
No? I'm not hearing again.
You're not hearing me?
Honey?
Are you sure Grace is talking to this audience? Okay, Kachi, your hand is up. I think Grace is off. She's out. She'll come back. And maybe her network or there was power issues. Because I had her saying, honey, she was talking to her husband or something. Aisha is laughing. All right, go ahead, Kachi, please. Let's hear your thoughts.
Okay, sir. Sorry for taking us back a bit.
No, it's fine. It's for us to understand it. Please go ahead.
Yeah. So, in the pharmaceutical example you cited,
yes.
where all cash receipt is via transfer.
Transfer, exactly.
How about the cost of that in terms of bank charges on the part of the organization?
That's why they said control risk is not high. So that's another cost. There's a cost for controls. So the cost may be lower than fraud. Now, if you look at the amount of fraud that goes as a result of cash transactions yearly, I think ACFE said, that's Association of Fraud Examiners, Association of Certified Fraud Examiners, ACFE. They said organizations lose at least 20% of revenue yearly to fraud, and mostly come through this cash transaction. So if you look at the proceeds that go to bank charges because of transfer, and they are high-level transfers. Somebody can do 100 million transfer to buy pharmaceutical drugs. They just tell you, Gabriel, now I transfer 100 million. You won't confirm it. You could see the charges that go with such a transaction, but then it's better to do that. The organization feels it's better we incur those charges on bank transfers and bank charges than face the issues with cash and the fraud tendencies that come with it. So it depends on management's appetite, risk appetite in the area of bank charges and all that. They will have weighed the pros and cons and felt this is better for us. Let's pay the bank charges than face these issues of cash wahala.
Okay. Yeah. Another was control. Some controls come with costs.
Exactly. Some, in fact, not just costs, high costs. Some controls, some ERPs, they will tell you, man, you see how much they pay yearly. Like currently where I work, man, the controls, when I look at the money they spend on Tally Prime, man, it's not small money. But then everything circumnavigates around the Tally Prime. Every transaction must be in the Tally Prime. So just imagine there's no control, there's no system, there's no ERP to work. The organization will be susceptible to a lot of fraud. Like I'm doing a procurement audit now between a particular period. I'm doing 15 billion naira procurement and everything is on the ERP captured. So the cost, you have to count the cost and look at which one is avoidable and unavoidable cost, relevant and irrelevant cost. Yeah.
Thank you, sir.
All right. Good questions. Is Grace back so that we can take your questions? Grace, are you back? I think maybe power went off or something. So she was asking her husband. Okay. So in looking at exam tip, we're saying think about controls. If they fail, then the material misstatements, risk of material misstatements in financial statements survives, and there's control risk. So around all these areas, you could point to control risk. We just spoke to some examples on the screen. So look out for questions like that in the AAAF paper. Okay, so that's it about control risk. Let's look at detection risk quickly. And detection risk belongs to the auditor. You can call detection risk the auditor's risks, speaking to the auditor's procedures failing to detect risk of material misstatement in transactions or account balances. So the auditor is supposed to first assess inherent risk and control risk. So in his assessment, he just detected that inherent and control is high. That means his detection is low. That's what it means. You have detected based on your assessment that inherent and control risk is high. You've done your job, so detection risk is low. But where you've done an assessment and you found out that from your assessment, inherent risk and control risk is low, then your detention risk is high. So look at it inversely in that area. So detection risk speaks to that risk that procedures he has performed fail to detect material misstatements in transactions in the system or imbalances. So the key features, for example, a detection risk of 10%. 10% chance speaks to audit test will miss a misstatement. So detection risk is low. That means 90% is correct. So unlike inherent risk and control risk, detention risk is the only risk the auditor can directly control. Take note of this. Yes, please, Kachi, go ahead.
Again, apologies for...
No, please. Really, don't worry. Yeah.
Sir, please, I need you to kind of emphasize this area. You say if detection risk is 10%, for example, what that implies is it is 90% correct.
Exactly. So it's low. So if you have 90% based on your assessment, for example, that detection risk is 10% is the chance that audit will fail to miss a misstatement, then it's low. But where you have the inverse, detection risk is 90% chance that test will miss a misstatement, then detection risk is high. But at 10%, detection risk is low, so it's acceptable. Don't forget, we said for all the risks, you cannot annihilate them totally. You can only bring it to the barest minimum. There is no absolute assurance in risk management. You can only reduce it. And where you can quantify it to a percentage, then it's fine. So if you say detection risk is 10% chance that audit test will miss a misstatement, is acceptable. But where it is 90%, 80%, 70, 60, even 50%, then you still need to perform assessments and still need to do more of substantive testing to reduce the detection risk. That's what we are saying.
Okay.
Yeah.
Okay. So the lower the detection risk, the better.
Exactly, the better for the audit.
Let's say if the detection risk is 5%, it means that we are 95% correct that the opinion we have given is correct.
Exactly, but you cannot have detection rate at 0%. It's not possible. You can't have them. The auditor is not realistic. You cannot have any of those risks at 0%. So take note of it. It's not possible.
Thank you,
yeah.
Thank you.
All right. You're welcome. Okay, so like we said, unlike inherent risk and control risk, detection risk is only risk the auditor can control directly. He can control it by the nature of audit procedures he performs, the effectiveness and the appropriateness of those audit procedures. Also, the timing of the audit procedures. Is it interim or year end? That means interim half year or the full year. You can also you can control it by the extent of the audit procedures, the sample size he covers, the level of detail he covers. So how detection risk links to audit risk is that the audit risk speaks to inherent times control times detection. We know that formula. So the auditor can set an acceptable audit risk at 5%. Let it be lowest, like Kachi said. It can be brought down to 5%, 10%, 15, 20, something like that. But you should have a threshold, a quantifiable number, measure that, okay, it has come down to this and we can accept that financial statements, or there are no risk to material misstatements in the financial statements. So in assessing inherent and control risk based on the client and the control, so the client's business and the control, inherent risk has to do with the client's business and the control risk has to do with the internal controls. The auditor can adjust detection risk through audit work to achieve a good targeted audit risk and a low percentage. So the management versus auditor control, the inherent risk we spoke to cannot be reduced. It's inherent to the business or the account. Even if it can be reduced, it's slightly. Control risk can be reduced only by the clients installing good design and implementation of internal controls. And it can be used by the auditor for future audits. So in the first year, he can make control risk high. Then after his assessment of the controls, in future, he can reduce his substantive procedures. But the detection risk is managed by the auditor. He increased testing where he finds issues with the control and the inherent risk, or use better procedures depending on his assessment of inherent and control risk. So an exam quick phrase is that detection risk is the auditor's risk and is reduced by doing more, better, or later testing. Very simple. And that's what detection risk is all about. Kachi, I hope this resonates with you a bit.
Yes, sir. Thank you.
All right. So I think if you go back through the slides, all these thoughts, you will not see them in the case, the AAA study text. The AAA study text is a bit more complex. It almost got me confused to some extent, but then I had to streamline it like this with some risk management tools I was using. So I'll suggest you complement, if you are going for the study text practically, complement reading it with these thoughts on the PowerPoint slide. Okay, so that's the end of detection risk. Let's now summarize the audit risk assessment, which is a summary. The audit risk model, we've looked at it, is the inherent times control times detection. And we have this just little graphical presentation. The inherent and the control speaks to more detection risk needed, and the auditor's response in the inherent and control is a high risky environment, speaking to weak controls, speaks to low detection. So you need to extend testing when there's low detection risk, larger sample size, more substance. So everything we've spoken of, we just posted it here in a graphical representation for you to see it, how tabularly you could understand the audit risk model. So the key takeaway is that where you have a high inherent and control risk, the auditor must lower detection risk by doing more testing. When we have lower inherent and control risk, the auditor can accept higher detection risk and test less. So balance is key in ensuring the overall audit risk remains as an acceptable level, 5, 10, 15, 20%. And always link risk assessment to audit effort. In fact, before doing the audit job, you have to do risk assessment, understand how to carry out a risk assessment process and the 5 components of internal controls we've looked at. And generally it speaks to the exam tip. The higher risk, you do more work. Lower risk, less substantive work. Simple. That's the summary of the audit risk assessment in a nutshell. Okay, so let's look at this long, a bit lengthy session. It speaks to the connection between business risk, financial statement risk, and audit risk. Business risk, like we've seen in the audit approach, is any risk that threatens the achievement of the objectives of the organization, like profitability, where profitability is eroded, maybe the company is making losses, and where going concern is threatened, there's business risk. And it can be at a it can be reduced to an acceptable level, where you have low probability of the business risk and its low impact. You don't need any heavy controls. And the applicable risk is that where you have high probability of business risk, high impact, it must be managed through the TARA framework, transfer, accept, reduce, or avoid framework. So an example is maybe a new regulation in a fitness center, gym center. The industry speaks of the risk of license withdrawal not to operate. And it could culminate in cash flow shortage, the risk of inability to replace key equipments are those risks that may affect the business around a fitness center business. And number 2, the link of business risk to financial statement risk is that business risk may translate into financial statement risk. For example, it may culminate in bad debts understated, receivables overstated, inventory obsolescence in high-tech sectors, inventories overstated, failure to recognize provisions, estimates, liabilities understated, impairments ignored, non-current asset overstated, then some risks, for example, reputational risk, customer dissatisfaction, may not directly distort financial statement, but could threaten the existence, sustainability, and going concern of that business. So we need to look at the audit risk to help us navigate around the business risk and the financial statement risk. The auditor's risk is giving the wrong opinion materially misstated financial statements. So it follows directly from financial statement risk. And from what we saw in the last conversation around the inherent risk, we said the audit risk component speaks to inherent risk, which is a misstatement likely by nature of the business. Control risk simply is the client's control may fail, and detection risk speaks to the auditor's testing may miss the error. So the exam focus is that the types of financial statement risk to spot, especially high value, high focus areas, are overstatement of revenue in the area of IFRS 15 timing issues, then overstatement of receivables, inventory, talking about net realizable values of bad debt allowance, overstatement of non-current asset, fixed assets, impairments ignored, understatement of liabilities, provisions estimates not made, an understatement of expenses, ratios inconsistent with prior year results and all that. And also estimate risk, management bias in making those provisions, estimates, in fair value measurements and all that. Non-compliance with standards are also an example. Contingent related party transactions, deferred tax issues. Then a case examples like we saw in this fitness center we just spoke about, a fitness or a gym center, could be the business risk around accident in sauna. Speaking about loss of their license to operate. Maybe clients had an accident during gymming or having their exercises, and regulatory authorities came and sealed down the place. The financial statement risk of that incident is that license may be impaired, revoked, and provisions for penalties may be required for not putting adequate mitigants to ensure the safety of clients and those that patronize such gym places. So the audit risk is speaking to the auditor must test licenses, impairment positions, and adequate controls around the environment and how the safety of clients and customers is adequate. So other links speaks to fees paid in advance by most of these gyms. You see that they pay, maybe they subscribe monthly and all that. The risk of deferred income misstatement, they will recognize revenue before those clients use the service. Stuff like that are risk areas auditors need to assess. Delayed hydrotherapy, where we're speaking to pool project, the impairment of construction costs, then poor staff retention of such gyms, the risk of errors in accounting returns and all that. And those are practical examples on how to help access the audit risk model very practically. Okay, so Sam asked a question on the update. So this is a key update that is not in the former study text. The new study text captured it, and that's sustainability assurance. ISA 5000 and ISA 3000. You will not see this in the old study text. So KU and Sam, take note of it. This is a key update in the new study text. So sustainability assurance is linked to this because it affects business objectives, business risk, and going concern issues. Speaks to business not being able to be sustainable. So auditors need to be able to help provide assurance in helping business stay sustainable and foreseeable, operate foreseeably in the future. So sustainability assurance is a new injection or new development in the area of audit, and is needed because it helps in transparency and accountability to stakeholders. That's what sustainability assurance is all about. And ISA 5000 has brought it to limelight. Is a standard that covers that. It helps in early risk detection. That's why it's needed. Early risk detection, talking about climate change, resource scarcity, resource allocation, better decision making by the board, management, and compliance to regulations, internal and external. It also is needed because it enhances efficiency gains, talking about energy, renewable energy, waste reduction, and reputation and stakeholder trust. This is why sustainability assurance is needed. And the process around sustainability assurance speaks to the scope and objectives. The engagement letter, if you are providing sustainability assurance service as an auditor, the criteria must align with the standard. Data gathering and analysis, economic, social, and governance framework and the impacts, the controls and systems align practically with sustainability assurance, the ESG framework. The evaluation of policies and procedures, alignment with sustainability standards is part of it. And in carrying out this sustainability assurance engagement, you need to obtain, as usual for all audit and non-audit assignments, you need to obtain sufficient evidence through inquiry, through testing, through confirmations during the job. And auditors need to document everything also in the area of sustainability assurance, document everything, misstatements, deficiencies, and communications with management and those charged with governance. So the types of sustainability assurance are the same. That has to do with the audit and non-audit related service we looked at in chapter 1 and other subsequent chapters. So the types include limited assurance, provision of limited assurance, through inquiry and observation analytics. Auditors could provide limited assurance by saying nothing has come to our attention that there's a sustainability issue that would hamper or hinder the company from operating in the foreseeable future. So less evidence is provided in this kind of assurance because it's limited, and lower comfort to management is also provided. Also, we have the reasonable assurance or reasonable sustainability assurance is similar to a statutory audit work, because you test controls, you do substantive work, and the opinion is presented fairly in material respect. So you could say from the evidence gathered, nothing has come to our attention in all material respects that anything has gone wrong or will go wrong in the foreseeable future. So you are providing a higher comfort, but it's not absolute, it's reasonable at the same time. So this standard will go into effect by December 2026, but then the IASB framework has brought it. Okay, yes, please, Kachi, go ahead.
Okay, sir. So this sustainability assurance.
Yes, please.
So auditors actually express an opinion on it like they do for financial statements.
Exactly, but it's an engagement that is specifically requested. It's not a statutory, so it could be an ad hoc. They just said, okay, maybe auditors, they need, for a particular set of stakeholders, they need assurance maybe to give them those level of comfort that they are doing well in this area, not just statutory audit. So auditors could be engaged to provide sustainability assurance. Yes.
Okay, that means that maybe some level of training will be required, because it's not kind of like the conventional audits, like the statutory audit.
Yes. So what most of these big four do is they have a unit for that, are different from those that provide statutory audit. You can just see sustainability assurance unit, and there's an expert and engagement partner in charge of that unit. If they have IFRS 9 unit, the PwC I work with in my former organization has IFRS 9 department that does only IFRS 9. Sustainability assurance will not be so. They will have specially trained experts in that field or that department.
Okay. So yeah. I just noticed that this sustainability thing, I can kind of, make it cut across in most of the papers. You will see something about sustainability everywhere.
Yes. It's in case study too. It's in SBR. Yes. ICAN likes to align with global practice. So all those papers that they feature sustainability, ICAN just integrated it and aligned properly. Yeah, it's in almost 3 papers, I think. SBR is in case study and is in AAA AF. Yeah.
Is there an area to pay attention to?
Yes, we need to pay attention. Okay, I think Grace is back now. Grace, what happened? Your inverter, your generator went off because I had you talking to your husband. Honey, what happened? We had you now.
You were hearing me.
Yes, we were hearing you.
My network, the thing just disconnected me. I thought I was off actually.
Oh, you were using Oga's.
Hearing you again.
You were using Oga's Wi-Fi.
Exactly.
Me and Aisha were laughing at you now. Me and Aisha were laughing at you.
I was thinking he turned off his hotspot. He said he didn't turn it off. It was network that was just disgracing me. Please, I wanted to ask something about this audit risk setting. You said we should set audit risk threshold, something of that nature. When you were talking about audit risk set to 5% and things like that.
Yes.
Okay, my question is, for instance, when we are setting materiality threshold, we do it in relation to either asset or revenue or things like that. When setting audit risk, my question is, what parameter do you use? 5% of what or 10% of what?
Very good
Are
question.
we actually setting it? Thank you.
Okay. So in setting the risk, it is judgmental. Risk is different from materiality, because materiality, you have a benchmark. You can use, like you said, revenue, you can use profit before tax, you can use profit after tax. But for audit risk, you can only, based on your judgment and quantifiable assessment of IR and CR, that is inherent and control risk, now determine, okay, your detection risk is 5%, 10%, 15%, 20%. So it's based on the assessment of inherent and control risk, and that is judgmental. There's no threshold or a particular component like revenue to benchmark it. So an auditor will assess inherent risk and control risk. Then based on the high, medium, low method, he can determine, okay, detection risk is 5%, detection risk is 10%. So what does that mean? Is as low as 5%. That means the financial statements will not be materially misstated 95%. So the material misstatement and the susceptibility to any material misstatement is as low as 5%, and there's clarity. The financial statement will be clearly presented. Is saying 95% is okay. But where you have detection risk at 10%, that means the financial statement materially may not be misstated at 90%. So inversely, what we are saying is you need to reduce detection risk to the BRS minimum. Where you have detection risk as 30%, and you know from your judgment as the auditor that inherent and control risk is your detection risk after assessment of inherent and control is 30%, then you still need to do more work. 40%, there's problem. 50, there's problem. And that will affect the reputation of that firm. So bringing it down, and you have that comfort by yourself, by the work you've done. The auditor knows when there's a risk, and he still goes ahead to put his head. It will crystallize. We know as auditors. So in answering your question without going into detail, what I'm saying is that 5%, 10% is judgmental. It's based on the judgment of the auditor and his risk assessment. That's why you must understand how to do risk assessment as an auditor, especially in practice. That's when you can come about with this quantified figure. But in exam condition, you don't need to do a risk assessment to answer an exam question. When a case study presents himself, you just know that detection risk is supposed to be at least as low as 10. It should not be even more than 20%. You know that 80% the financial statements will not be materially a statement, and that's what you need for the exam. Then in practice, you know how to navigate the rest based on qualitative and quantitative factors. I hope I was able to clarify
so
a bit.
In exam, it is possible for them to tell us that detection risk is so percent. We're not meant to. Okay, all right.
No, you are not to perform any. Yes, you're not to perform any risk assessment, but you should know that it should be as low as reasonably possible. As low as reasonably possible. The ALAP framework, as low as reasonably possible. But you cannot annihilate detection risk totally. In fact, all the three risks, none can be eliminated. If you have 100%, then you are saying your assurance is absolute, which is not possible in audit. Your assurance cannot be absolute, so please take note of that. Okay. I'm really enjoying the engagement with Grace and Kachi. Really bringing fantastic questions. All right. Okay, so just give me 10:04, man. I've not even entered materiality. That means we still have to have another class because materiality is the core area. Okay, so let's round up this audit risk model, if you don't mind, please. Let's round this up. at least this sustainability assurance. Then we'll, in the next class, meet for materiality. So in talking about ISA 5000, we've spoken to reasonable assurance, and we said reasonable assurance provides higher comfort, but not absolute. Assurance can never be absolute. So ISA 5000 has key points. It will be effective by December 2026, but it's integrated into all curriculums. In fact, IFAC has integrated it and it's examinable. So it applies to all sustainability assurance engagement. And the objective of this is to obtain reasonable or limited assurance like we've seen previously. And is expressed through written conclusions and opinions, and also communicated through significant findings. So the practitioner or the person providing the assurance must ensure independence, as usual for auditors, competence, and provision of resources. You must plan the engagement, set materiality thresholds, as we do normal audit, and also supervise the team. You must also ensure misstatements and communicate with those charged with governance, just as it is in statutory audit. The same roadmap. You must also consider fraud and non-compliance in performing these duties. So in exam, which is highly suspectable because it's first time it's showing up, always show the flow around business risk, financial risk, and how it culminates in audit risk. So use case facts. For example, fees in advance and how they are recognized instead of being deferred before provision of service, something like that is a deferred income risk. So IFRS 15 states that before revenue can be recognized, it must be earned. So you subscribe to a gym and it's a monthly thing. And you subscribe maybe 100,000 to spread for 30 months. And you've not gone to the gym, and the gym has already recognized it as revenue, 30,000 from Gabriel, Josiah. That is wrong in accounting. And that's what we're talking about, deferred income risk. Until Gabriel comes and consumes that service, uses the gym is not allowed to recognize revenue. That's what IFRS 15 states. So in assessing audit risk, several parameters need to be understood and the framework applicable to that standard, and they must recognize the and disclose areas of material aspects in the financial statement. So for sustainability, you need to link assurance type to the level of comfort. The lower level of comfort, don't forget, is limited assurance. Then the higher level of comfort is reasonable assurance. So link sustainability assurance to the type of comfort and the procedures to perform. So that's it between the connection between business risk, financial statement risk, and audit risk. And take note, in the old study text, you won't see the sustainability assurance. It's in the new study text that it was injected into this. All right. So, ladies and gentlemen, this is 10:12. I'll have to stop here